Thank you everyone for joining us for our quarterly webinar. Um, got, of course, extra excitement to discuss. This time we've got um, a new war to rattle investors potentially, but thus far the stock market response has been surprisingly calm. The risk of a broader conflict has spiked oil prices, but the focus of investors continues to be mainly inflation earnings in our unexpectedly resilient economy. Compounding those geopolitical events is our own domestic struggle in the House as we seek a new speaker. It's not at all clear how this is going to get resolved, but eventually it must for our government to function. Adam will go into more detail, but it's surprising to me how little press the long-term Treasury debacle really is getting. So last year, long-term treasuries had their worst ever year. This year, year to date, returns are worse still. And this will actually make the third straight year of negative returns. And for convention following investors, they will have endured in the last 15 years the four worst ever returns, annual returns on the supposedly safe investment. Fortunately, stocks are recovering from last year's decline, and as Andy will cover, there's reason for optimism ahead. Adam?
Great, thanks all. And yeah, just in general, a snapshot of what happened across the major asset classes last quarter, across both stocks globally and the bond market. And we'll look at this at a really high level and talk about two really important themes, one of which Lowell already mentioned, that are worth some attention and consideration when you think about what things look like going forward. But in general, a fairly quiet quarter for markets across the board within equities. You didn't really see any major divergence between domestic and overseas. Global real estate, REITs in general were one of the more harder hit asset categories within equities, mainly because of their interaction with interest rates. And so when rates go up, real estate from an investment standpoint tends to struggle to compete from a yield perspective. But the bond market, another down quarter, and one that probably warrants more attention relative to equities. We've seen in the last couple of years, 3 consecutive years of negative returns for bonds, and that includes some of the worst quarters and the worst calendar year, top to bottom dips for the bond market, especially when you look at the longer term maturities. But again, to Lowell's point, with everything happening and what's carried over from last year into this year, there's still, I would say, been a lot of resiliency within the equity markets, which is, again, probably been another reminder how difficult it is to time and react to these, whether it's geopolitical or economic headlines, and try and make investment decisions based off of that. So that's a snapshot for the quarter. And if we look back the last several years, trailing 1 year, something to really note is there's been a ton of conversation about the divergence between, U.S. domestic equities and what's happening elsewhere in developed markets, specifically overseas. But one of the themes in a really rough 2022, especially in the second half, was the strength of international markets compared to domestic. So diversified investors who have a little bit of U.S. equities, international equities, finally, after a several-year break, have gotten to see some of the benefit of including, those overseas companies in their portfolio. And so outside of that, no real major change in the key trends that have happened in the last several years. So I want to really focus specifically on two things market related that should warrant a lot of attention and a look under the microscope. The first being the concentration of returns this calendar year. So when you think about the headlines and the market as a whole, the U.S. stock market is made up of thousands of different companies. And some of the major indices, specifically the S&P, takes baskets of these companies and weighs them to try and give investors a gauge of what's happening market wide. So, Andy, if you can push forward, I want to kind of focused on theme number one, which is the concentration of the current state of the U.S. stock market in terms of how only a handful of companies are driving an overwhelming majority of the positive returns that we've seen this year. So I'm going to explain what's pulled up right now and highlight its importance. This is going back a couple of decades, and it's ranking, as you see on the right, the far right there, the S&P 500 performance in terms of the total index for that specific year. But right directly to the left of that, you see how much of that return can be attributed to just the top 10 to just the top 10 holdings in the S&P 500. So if you notice for this year, 2023 year to date, almost 97% of that 12% or so gain in the S&P is coming from just those small basket of 10 companies. And if you compare that to what's happened in years past, you'll notice that that is quite it's definitely an anomaly, and it's definitely eye-opening. You normally it's common to see some percentage of the larger companies dominate the returns to a degree to the tune of 30, 40, even 50+%, but to have almost the entirety of the S&P 500 return come from such a small group of companies is really something to note. And that's also reflected when you look at the S&P return versus just the equal weighted return for the same index. You haven't quite seen the recovery this year in the rest of the market as you have in just those very handful of companies. And so what does that mean on a forward-looking basis? These phenomenons tend to be mean reverting. These handful of companies were especially beaten down pretty bad last year in 2022. And so we would expect that as time goes on, the rest of the market you will certainly, come through a recovery period. And those investors that are diversified well outside of those, handful of companies will be heavily rewarded. And Andy will focus on that as well in a little more detail. But just super, it's getting attention, but still really eye-opening in historical context. The next real key theme on the investment front, as Lowell mentioned, has been, what has been happening with interest rates and how that's played into the returns within the bond market. And first I want to highlight, within government bonds, what has been, going back to really the 2020, what's been the return characteristics of bonds at various different maturity levels. So as a bond investor, you've got the option to buy very short-term treasuries that are only, 1 month in term, and you can buy long-term treasuries that go out 20, 30 years. And they all behave differently in terms of their volatility and how they react to rate movements. But something that, first thing I want to highlight is you notice the 3-year annualized return of the intermediate and really the long-term treasuries having 3 consecutive years of double-digit annualized losses, almost, encroaching on 20%. That's like a really bad stock bear market in a lot of ways. And you notice the worst top to bottom return over any trailing, 12-month period the last 3 years. You're seeing losses encroaching, well over, 30%. So long-term treasury investors have been absolutely, battered and beaten badly by holding on to those bonds as a result of what we've seen with rising rates. And so, not all bonds are created equal. Something we stress, when you think about investing in fixed income in your portfolio, you've got a lot of decisions to make. One of the big decisions we made a while ago was we're not gonna really be swimming in the waters of intermediate term and long term bonds at this point. We're gonna hold very short term maturity investments. And so we focused exclusively on really short term bonds. And so anyone else who's got fixed income in their portfolio, we still really, are big believers at this point that you're going to get, the best risk reward by staying really short term within your bond portfolio. And then looking at you hear a lot about the yield curve in the news that gets a lot of headlines. You've heard about the inverted yield curve, and I just wanted to kind of show in practice what that looks like right now. We've seen some leveling off of this, but still, I think helps support the case of the types of bonds you want to be holding in your portfolio right now and the type of yield you can achieve, um, for definitely less risk than going out, 10, 20 years. So what this looks at is on the vertical axis on the left-hand side, that's the yield, and the bottom axis there is time. So it's really just showing what yield can you receive on a treasury for each point in time. So you'll notice this is when you hear about the inverted yield curve, it looks like a ski slope, just like this. The yield for shorter term treasuries are a lot higher than yields on longer, term treasuries. Our focus has really been on 6 month and less. As you'll notice, that's kind of where things peak out to a degree. And then from there, you're not really getting paid to take risk by going out longer on the treasury yield curve. So you're even today, you're noticing and hearing about rates continuing to go up um, due to the continued resilience of the economy. And so we're now in an environment where, unlike, really the last 10, 15 years, you can achieve a reasonable rate of return on, on a short-term treasury. So the market's still trying to, flush through that. And I think the real big theme behind this, outside of how you want to position your bonds, has been the stock market really hasn't reacted to this to a large degree just yet. You've seen a ton of resiliency with stocks with all of this happening. So as we go between now and the end of the year and into next year, this is still going to be something really to watch. But our stance is still within the context of an asset allocation or diversified portfolio to still really focus on holding very, very short term, fixed income, and not to try and, put yourself in your position for that type of risk. And then on the economic front, what are some of the things that we've seen? I would say that not much has changed drastically from last quarter to this quarter. You still see the labor market with sub 4% unemployment rate. Wage growth has slowed a little bit, which is actually a good thing when you think about inflation. But you've got people coming back into the job market. They're not demanding the type of wage increases they were previously. But you're still seeing a really, really strong labor market, and you're also seeing inflation after really the last 12 to 14 months of continued precipitous drops in the rate of inflation. It's kind of leveled off just below 4%. So the thought now, and the big thing and the key theme that people will be trying to parse through on a forward-looking basis is, how sticky is that, 3 to 4% inflation rate? How are we going to get from there down to that 2% target? And you even heard Fed Chairman Powell say the other day they're starting to kick the can down the road for when they believe that might happen. So an interesting dynamic is going to be, how comfortable are they keeping rates and inflation kind of where they are to let this all play out versus trying to find a quicker path to get down to that 2% preferred rate. And in the context of the inflation rate and the labor market, you've seen still this a waiting game of when is this going to start to spill over into profits of U.S. companies, and when are we going to see that slowdown in earnings growth and in the performance of equities? And we're last quarter you had 90% of S&P 500 companies beat on their earnings estimates. This quarter we're about 80% of the way through, and we've got about an 85% beat rate. So it's it's a continued game of watching the economy and companies learn to do a lot more with more headwinds, and to create that sense of resiliency. So we haven't seen things crack or break to the degree that we would have thought 12 months ago. And I think on that note, Andy's got a headline that is exactly a year old that will be a really good segue into his comments on, what are we doing within our portfolios at this point?
Yeah, it's a great segue, Adam. And the fact that you always share this chart that has a bunch of headlines. I did want to share a headline from exactly 1 year ago, which is this, which was Bloomberg letting us know that there was a 100% chance of a recession coming in the next year. And yesterday was the 1 year anniversary of this headline, and there's been no recession. We're talking here about the resiliency of the US economy rather than a recession. And I just wanted this to be a reminder that, sometimes you read things, out there in the news or, see things online, and predictions are really hard. And I would always have, or I would typically have antennas go up or red flags go up whenever we see people talking with a high degree of certainty that something is going to happen. Because I think one thing we see over and over and over again in financial markets is that we are surprised. Everyone thought that things would break when you go from near zero rates to over 5 where we are now. And, outside of maybe a few mid-sized banks, we just haven't seen that happen. Not to say that it can't happen, not to say that a recession won't happen in the future, but it makes sense to be wary of some of the things that you read. And, I think one of the things that makes people a little wary is you showed the performance over the last quarter that showed that, we had a negative quarter for performance kind of across the board. But it should be noted that Septembers are historically the worst month of the year for stocks. And this is so consistent, and the effect is actually so strong and has a name. It's called the September effect. And there was just a recent Planet Money episode by NPR where they brought on a professor, Lily Fang, who's a professor at some business school in France, who researches this. And what she's found is that the thing that explains this the most is that people go on vacation over the summer, and they react slowly to bad news that occurs over the summer. And then once they get back, once you have your traders getting back into the office in September, they start unwinding the negative news, and they start, having negative reactions with their trades. And it's interesting because the September effect happens in the US, but she studied holidays in other places like, New Year's in China and other such, times where people are out of the office, and it also happens in other countries. So, September tends to be a bad year. Just looking back at the past 4 years, that definitely played out. And, there's always reasons for this stuff. Like say in 2020, there were fears of a COVID wave. In 2021, there was a major Chinese property developer that went bankrupt. We're concerned about the debt ceiling. That seems to come up every so often. The monetary policy concerns. In 2022, it was really negative. We saw the return of inflation after originally thinking that we were on the backside of it over the summer. So there were reasons for it. This time, maybe there's not such a clear reason. Maybe it's, finally this higher for longer messaging from the Fed kicking in. Maybe it was the big seven, the Facebook, Apple, et cetera, stocks actually declining a bit in September. Maybe it was rising oil prices. But regardless of whatever it was that caused the decline, we've seen in each of the past 3 years, when we saw a big negative September, we saw strong fourth quarters. And, so in 2020, it was a strong snapback. In 2021, the same thing. Even 2022, that was really the start of the end of the bear market that occurred, that year. And stocks have actually, continued to rise mostly since then. And so it brings us to the big question is, again, we saw September returns this year negative. What's that going to mean for the fourth quarter? And I actually think that there are reasons for optimism. Some of us, I think Lowell on this call also attended a webinar that Goldman Sachs did just yesterday, where they were talking about their, forward-looking expectations. And they have an interesting approach. Goldman employs an army of analysts that do what's called bottom-up analysis. Basically, they look at what individual companies, like how they're performing, and they create price targets for those individual companies. And then they use that data for all the companies that they analyze to estimate what that means for S&P 500 returns. And what they've found is that, they are expecting some pretty strong returns over the next 12 months based on this type of analysis. Just a year ago, they were predicting a very similar thing, where they were actually predicting even stronger returns moving forward than they are now, but still strong returns. And that, as you can see in the last slide, that really did pay off as returns were up. Adam showed the slide where, over the last 1 year, stocks are up something like 20%. So they were almost dead on. They were predicting 28%, and stocks were up 20% a year later. So it's not quite that strong of an expectation from Goldman, but they are expecting better than average returns over the next year, which leads me to believe that we could see, strong returns this quarter. One other thing that's happened over this quarter where we've seen stock prices decline is price targets have actually moved higher. So really across the board, across the market, price targets have increased about 5%, despite the stock market declining in value. So that leads it to be even a little bit more undervalued right now. And in fact, Goldman is predicting a 23% chance of a 5% or more move in the next month, which is above what options are pricing in. So the market is pricing in about a 12% likelihood. So they see, higher than normal upside participation potentially moving forward. So I think sometimes, we focus on headlines. They tend to be negative. We tend not to see the positive ones. I just wanted to start out with an optimistic bent here before, moving on to what, I typically talk about, which is our investment strategies. And so, I've shared this chart a couple times, most recently last quarter. So I'm not going to spend too much time talking about size and style positioning, other than to say that nothing's changed. If you've attended these webinars in the past, it's the same message. We are expecting small cap stocks to do well moving forward. This is, I call it the wave chart. It looks like the wave is beginning to crest, which would be bullish long-term for small caps. And, this is over a rolling 3-year time period. This chart, so the recent strength of large caps, isn't quite, it's not making a dent here in the long-term trend that we're seeing. Similar story for style. Again, we just went through this pretty long pro value phase. It paid off in 2022 to be positioned that way. And we've seen pro growth momentum begin to take hold. And just given the historical relationship between the cycling of value stocks versus growth stocks, we're due for growth stocks to do well. And so our expectation here is that we'll see the wave start to fall, and we'll see more gold on this chart when we roll forward to future webinars. And our portfolios are basically fully positioned to take advantage of expected small cap strength, and we're beginning to rotate towards growth. We've begun that rotation. It's not a full tilt yet, and I'll explain why in just a couple of slides. We're not quite all the way there, but one thing I did want to share, this is a model that I haven't shared in the past, is I like to look at that rolling chart that I just shared for both size and style, because it shows what the long-term trend is, and that's really the aspect that we're playing. We want to make sure we're positioned for the long term. We're going to sometimes be wrong-footed over a month or a quarter or whatnot, but that does tend to be pretty predictive. But another piece of information we look at is this very short-term, signal. So basically what this is telling us is what is in favor right now. And what you can see here is in early 2023, we're talking about size with this chart. Large caps were strongly in favor, really through March and through the spring into early summer. And so when Adam showed that chart that showed the top 10 stocks have contributed 96.5% to the returns of the S&P 500, this is largely what happened. You could probably, I know this is just talking about large versus small, but it was really the very largest stocks were the ones in charge. And more recently, though, once we got into the second half of the summer and into the fall, we've seen more even returns for large caps and small caps. So we haven't really seen a big, move forward in stocks. We've sort of been trending sideways for a little bit. But there has been more, it's just been more equitable, the types of returns that you're seeing between the large caps and the small caps. And so, what we see here is we would like to see this start to move above the origin here, so above that bolded line. And once that happens, I think we'll see a nice strong breakout in small caps. But as of right now, at least there's no more large cap momentum that's really taken hold, and we're just kind of waiting for small caps to begin their move. But with regards to style, so this is the piece that's changed so far this year. If we enter 2023 in pro value tilt, over the course of the year, we've gone to neutral and even begun to tilt a little bit towards growth. And we haven't gone all the way yet to our full growth tilt. And it's because we haven't seen the short-term momentum quite get there yet. So what we're seeing here, again, it's a similar story to size, where there isn't really, a strong, short-term trend right now. There was one earlier in the year when growth was in favor, and this is across large, mid, and small cap stocks. But right now we've seen things just sort of moderate, and sometimes value's in favor, sometimes growth's in favor, not really a clear trend. But for us to take the next step and maybe move closer towards our full-on growth tilt in portfolios, we'll want to see this short-term momentum pick up a little bit. So I did want to take a moment to talk about stock selection, because we spend a lot of time talking about size and style, and we focus on that because that's really the most important decision for us to get right. If we're right about size and style, it tends to be a bullish thing. But if we're wrong about size and style, no matter how good your stock selection is, it can be difficult to counteract that. And so that's the most important piece, but stock selection still is important. And we spend a lot of time thinking about which stocks we're going to buy. We spend a lot of time building out models to predict which stocks will do well. And so there's really two models that we build here internally. I'll call the first one really kind of our standard score model. And, basically what that is trying to predict is which stocks are going to do well, just generally in normal market environments. And I'll define a normal market environment as one that's, like a standard bull market, or even the beginnings of a bear market. And what the type of stocks that do well are the ones that are well supported in the academic research. So stocks that show attractive valuations, high profitability, high quality, these are the types of companies that do well. So our standard stock selection model really tilts towards these types of factors, and then chooses stocks that have these factors that are associated with long-term stock returns. But there is a time when this model actually doesn't do well, and I'll call that sort of like the recovery time. And so really it's in the aftermath of a big bear market. You can typically expect basically a V-shaped recovery. There will be a big downturn. You don't know when it's going to end. It could be 20, 30, 40, 50%, whatever it may be. But once it bottoms out, you can expect stocks to begin to recover lost ground. So we call this our recovery score model. And, we build it actually the same way as our standard model, but we just train it on a different interval. So instead of looking back at normal market times, we look back at the aftermath of past bear markets during these recovery phases to figure out which factors were associated with excess returns during those recovery phases. And so what we find is things like momentum and beta are really important. And things like value and profitability and quality, really, they're much less important by this recovery model. So, it's built the same way, just trained over a different time frame. And so there's really a lot of synergy, I think, between our standard model and this recovery model, because they are just completely different models. There's not a whole lot of correlation between the two of them. And so I wanted to take a moment to share, what the performance has been over the past year of this. So this is our standard model. It's always on, even when we expect it to underperform like we do now, we still have it on because we want to make sure we're buying stocks that we believe in or can believe in for the long term. And one of the things that you can see here is that in the months where we saw strong returns, so like in January, June, July, the blue bar where it says these are the buyable stocks, they tend to outperform, or sorry, they tend to underperform the stocks that it rates as holds or even sells. So we call this inverted performance. And so the reason that we decided to build a recovery score in the first place is because we were tired of looking at performance like this. But one of the other things you can see, like in December, August, and September on this chart, is that when there are declines, it does tend to be pretty protective. So maybe, your stocks that are in that buy range will still go down a little bit, but they won't go down as much as the ones that it rates as sells. With the recovery model, it's a completely different experience. So now, January, June, July, we're seeing those blue buy bars be very strong, and the stocks that the recovery model thinks are, that we should be bullish on do very well. The ones that it is bearish on don't do well. And but it's a double-edged sword. So again, December, August, September, when we had down markets, all of a sudden the stocks that recovery score said to buy are down more than the other stocks that it said to avoid. So this is almost like the exact inverse of our standard model. And so what we do in practice is, while we do have our standard model on all the time, we have the recovery score model on during these recovery phases, but we actually don't look at those two signals in isolation. We blend them together, because really what we want to do is we want to buy the intersection of both, where if we can find a stock that standard model likes long-term, recovery model likes over this recovery phase, that's really the sweet spot. And what we've seen is when we blend these models together, we see a much more consistent experience. And so now we're seeing the buys outperform the sells in the down months, but also in the up months. So this combination of the two has been very effective again this year, and this is really typically how we think about implementing stock selection. So it might have been the case in the past that we weren't able to take advantage of these recovery phases. Now we believe that we are able to take advantage of these recovery phases by blending those two models together. All right, and let's see, how did we do on time? We're 1 minute over, so we went 1 minute over today. I think that's pretty good. So I just wanted to take a moment. If you put any questions in the Q&A,
Andy, there's one that I can address quickly. So
Okay,
in the Q&A,
sure.
there was a question where they wanted an explanation of what beta means. So
Mhm.
beta is a measure of stock volatility, and if an average company has a beta of 1, which means that if the market's up 10%, you would expect that company to also be up 10%. A beta that's more than 1, so let's say a beta of 2, as an example, if the market's up 10%, you would expect that stock to actually be up 20%. So high beta stocks are the types of companies that are attractive for that recovery score model. It's those high beta stocks are also considered riskier stocks. And that's another way to characterize the two models. The standard score model is sort of a risk off, bias towards quality type model. And then the recovery score model is risk on, bias towards the more aggressive companies that have been sold off the most and then are most likely to outperform coming out of that. I think that was our only question, Andy.
Yeah, thanks for that explanation.
We
Yeah.
had a couple more, Andy, on
Okay.
just that had come before the web, and we got a couple questions on AI, and I think just like as an investment opportunity. So, and I think that probably carried over from last quarter also. So, do we want to talk about that just like in concept? I was just going to say in response to that, um, in terms of what's happened this year already, is it probably fair to say that the AI thing could be overblown, and that a lot of these top 10, if you look at the companies that have dominated most of the performance, a couple of them probably have something related to AI happening under the hood, but a lot of it is probably just related to their pricing power with inflation and, just their dominance as businesses, and not specifically just the AI piece of it, but um, just in general, like, are we in our selection process, is AI like propping up at all in terms of thinking about stock picking?
Yeah, I think the thing to keep in mind with AI is like it's become part of like the social conscious now, probably because for the first time ever, it's really broadly available with things like ChatGPT. Like I can't tell you how many applications, even things like Snapchat now have like an AI assistant that you can ask questions. So I think it's just more top of mind for people, but there's been decades of work on AI behind the scenes that all like the major tech companies have been doing, and so it's something that maybe isn't explicitly accounted for. We're not specifically targeting AI companies, but there are lots of companies that have been using and leveraging AI tools to help increase efficiency. I think you have to be careful sometimes with these companies that are just like putting AI in their name to try to get a boost, because it's somewhat unclear that just because you're doing work in AI, that's going to mean big profits down the road. Like we've seen, like the theme of the day, the trend of the day, like 3D printing, like marijuana stocks, like cryptocurrencies have like a moment and then have really poor performance afterwards. I would be a little bit cautious about trying to get into, the AI craze now. I agree it feels maybe a little bit late, but I think a good example too is, everyone was saying, oh, Chat GPT's here. Google is going to really struggle. Why would anyone go to a search engine when they can just ask their AI assistant? And it turns out Google too was also working on AI just more quietly in the background, and their stock price has done very well this year after people were making predictions of Google's demise. So, it's definitely an interesting theme. It's something to focus on. But I would definitely, caution against maybe getting too excited about it.
Let me also weigh in on that just from a slightly different perspective. So um, AI is an example of a transformative technology. This is going to change the way um, our economy works, the world works forevermore. It's just kind of same sort of disrupting effect that the internet had, where today you can't even imagine the world before that occurred, but they're actually some of us will remember a world that existed prior to that. So this will have a huge impact, and on an overall basis, it'll be a beneficial impact, but it'll also be disruptive. And what disruptive means is there's going to be winners and losers in this. And I think that's from a stock selection standpoint, that's going to be the most important area of focus. It's not necessarily who's making the AI available, but it's more how are the companies adapting to this new reality. The companies that are slow to adapt, are going to be at risk. The companies that are embracing and intelligent about this, they're going to get a big opportunity for a leg up on their competition.
And we got another question that came through around it's a sector specific question around defense stock performance in 2024. Lowell mentioned what's happening, just geopolitically around the world with Russia and Ukraine starting last year, and what's propped up recently, in Israel. And one thing that I think we can all agree on in general is just there tends to not be a real strong correlation between what's happening geopolitically and stock market performance. It's just something that there might be a very short-term type of reaction from a stock market perspective, but typically sooner rather than later that gets sorted out, and the market tends to focus on earnings and economic growth like it normally does. But do we have anything specific about like the defense stocks outside of that?
Yeah, I mean, defense stocks almost feels like a utility or something like that, where those companies are always going to be, they're going to be getting contracts. They're going to be, probably having pretty attractive profitability. I'll say a lot of the defense stocks do flow through in our stock selection models. I don't, I don't have the specific numbers in front of me right now, but oftentimes they're not bad investments. I will say that Goldman webinar that I mentioned earlier, where they were taking that bottom-up approach, they also broke down sector performance, and defensive stocks or defense stocks were sort of in the middle ground. Interestingly, they were most bullish on biotech, retail, and it was biotech, it was retail, and it was like defensive stocks, like consumer staple stocks, not defense stocks, defensive stocks, that they were most bullish on because those were the stocks that were relatively more beaten down. And then it was actually things like oil companies they were least bullish on moving forward to the year ahead. So I think defense stocks sort of, our expectation sort of middle of the road performance would be what I say. Lowell, do you have anything to add to that?
No, other than the fact that the world is not getting more peaceful. So I don't know if we'd want to have portfolios that didn't have some exposure there. But there's lots of other attractive equities down as well.
Yeah, we run into the sector conversation a lot around election time too. Hey, like what sectors are going to be good for this, presidential candidate? And one of the things we shared at a prior webinar is like there's almost an inverse relationship between what sectors you think are going to do well for a particular president and what actually happens. So, and I think the same could be applied just in general. It's that it's very difficult, to specifically predict short-term sector moves. Things get priced in and out very quickly, but just in general, if you look at what happens around the world, last year was really driven by interest rates and the economy more so than what was happening in Russia and Ukraine. And so there was like this initial shock period from that, and then the market kind of went back to focusing on just what it always does, regardless of what's happening. And I think it's easy to, probably expect the same going forward.
Yeah, absolutely.
All right, well, we're 10 minutes over, but thank everyone for bearing with us for the overage.
Yep, and this will be recorded, and we'll be sending it out. So if you need to circle back on anything, definitely you'll catch this recording via email, and definitely let us or your advisors know if you have any questions. But thanks, everyone.